Hey folks, welcome back to the channel. We just had a rate cut from the Bank of Canada. So this is probably the beginning of a series of cuts. And we've seen this before, most recently in 2020, where it went down to almost zero. This time, most likely, it will not drop to that low, but it could go to the 3s or 2s by next year. The bank alluded that they will continue to cut rates. So if that is true, what does that mean for the stock market? Well, here's a look at the historical overnight rate over the last few decades. And we have 4 noticeable easing cycles where these red lines mark the beginning of a series of a lot of cuts. And on the bottom, I'm going to show this stock market chart for the Toronto Stock Exchange. So Canadian Central Bank, Canadian stocks. And we can see when there's a cut, what happens over the next 6 months or so. In the early 90s, the market went down. The rate cut in 2001 coincided with another decline in the market over the next few months. 2008 was a little more arbitrary. We had a rate cut, and the market sort of went sideways for a while, and then it went up before crashing. So the actual decline in the stock market didn't happen until several months after the rate cutting cycle began. Most recently, before this time, was in 2000. We had rate cut, and of course, that correlated with a pretty steep sell-off of more than 20%. So that takes us to now. The market's pretty much flat. We've reached all-time high in the Canadian stock market, and we just saw a rate cut last week. So if we look at what this data is showing, basically 3 out of the 4 rate cuts in the past coincided with a stock market decline, and then the last one had a time lag before the market also went down. So based on this, we can expect to see some kind of volatility or a pullback in the Canadian stock market, which also correlates with the US market. So we'll probably see a decline there as well if the Canadian market goes down. Rate cuts are typically associated with a stock market decline because central banks ease often when the economy is not doing so well. And if consumers are getting laid off and they're not spending as much money, then that's going to hurt company profits as well. And it's not just Canada that's cutting rates. We're the first in North America to do it, but on cbrates.com, it shows which countries are changing interest rates and when. And if I go to last year, you can see most countries were still increasing rates as we were doing, as well as the US. So in May of last year, for example, the US increased by 25 basis points. And as we go up and closer to this year, you can see there's more of a mixed bag. Some countries are starting to cut rates. And as we get into January, February of this year, you have a lot more countries cutting rates than raising them. And that takes us to now, which is June. And so far, we've had 3 countries cut rates, including Canada, of course. And even last month, there's a lot more central banks cutting rates than raising them. So this is a sign that overall, the global economy is slowing down, and it's only a matter of time before the Federal Reserve in the US starts cutting rates as well. Now, that being said, while the economic and market fundamentals are signaling pullbacks, the technicals right now for the stock market itself is still looking bullish. And I've mentioned in my SPY options update a couple weeks ago that because the moving averages are all heading higher, it's most likely that the market is going to continue moving in that direction. And now looking back, it seems to be the case. There was a dip in the market last week when we look at the S&P 500, but it quickly recaptured that 21-day exponential moving average, this blue line. And not only that, but recaptured the green line as well, which is the shorter 9 EMA, and it continues to go higher. So despite seeing a pattern of lower stock prices after a rate cut, it doesn't look like the market wants to turn yet, at least in the short term. So for this week, I'm still bullish. As long as the S&P 500 can stay above the 9 EMA, then I don't see any reason to be bearish yet. But I would expect some kind of pullback between now and a few months later, say by August or September. So the market could do something like this, and it's going to fall to this support level, which was previous resistance. And from here, if it goes up, then we're looking at higher highs. But if it continues to go down, then we'll probably see lower prices as the Fed is expected to also cut rates around this time, which will be even more likely for the US stock market to fall. And just quickly, if we take a look at the Canadian Stock Exchange, the daily chart shows that it is already dropping, and this was even before the rate cut. Part of the reason was because a couple weeks ago, a lot of analysts were expecting a rate cut, so the decline here could have been a preemptive move to get in before the rate cut. And one thing I think people should pay attention to is this line right here, which is on an upward slope. Right now we have pressure coming down this way, and there's also pressure going up this way. Before the end of this month, one of these lines will get broken. If it's this line right here, then we could be going up a little bit more before having some kind of correction. However, if the market goes below this upward blue arrow, then most likely that's going to signal lower prices, which is what I'm expecting given the history of how the market behaves around the start of a rate cutting cycle. So anyway, those are just some of my thoughts for now. Thanks a lot for watching. Good luck with your investments, and until next time.